The UK government is running out of time. Debt is spiraling, borrowing costs are rising at an alarming rate, and financial markets are growing uneasy. If this continues, the country could be headed toward a full-blown economic crisis. The numbers are clear. Borrowing rates have surged to nearly 5%, economic growth is barely moving, and inflation is falling short of keeping debt levels sustainable. This is not just another economic cycle. This is a critical moment that could shape the UK's financial future for years to come. So today, we're going to break down exactly what's happening, why it's happening, and what this means for you. Stay with us until the end, and don't forget to like, share, and subscribe to Economy Explorer so you don't miss out on critical updates. The hidden danger: rising borrowing costs. For years, the UK government has relied on borrowing money to fund everything, from public services to infrastructure projects. This borrowing is done through government bonds, essentially IOUs, where the government promises to repay lenders with interest. Investors, such as pension funds and foreign governments, buy these bonds, expecting a stable return. But something has changed. The cost of borrowing has skyrocketed, creating a ripple effect that threatens to destabilize the entire economy. Just a few years ago, the UK government could borrow at extremely low interest rates, often around 1 to 2%. Today, that rate has surged to nearly 5%, a level not seen in years. And in just the last few weeks, borrowing costs have climbed rapidly, setting off alarms among economists and policymakers. But why does this matter? The answer lies in a simple yet crucial equation. If the UK's borrowing costs rise faster than its economy grows, debt becomes unsustainable. Right now, UK economic growth is barely 1%, and inflation is falling toward 2%. That's a total of 3.5% economic expansion, far below the 4.83% interest rate the UK is now paying. This means debt will keep growing as a percentage of the economy, forcing the government into tough decisions. This is where the real crisis begins. A government that borrows at unsustainable rates risks entering a debt spiral, where the interest payments on existing debt become so large that new borrowing is needed just to cover the costs of old debt. It's a scenario that has played out in history before, with devastating consequences. The UK government is now at a crossroads. If borrowing costs continue rising while growth remains stagnant, tough decisions will have to be made. Will the government slash public spending, raise taxes, or risk defaulting on some of its obligations? The reality is that without swift action, financial markets could start losing confidence, causing even greater volatility. Unlike in the past, when economic booms offset rising debt, today's UK economy lacks the same level of resilience. The cracks are starting to show, and ignoring them could mean severe consequences for businesses, households, and the overall stability of the financial system. What's even more concerning is that global investors are taking notice. The UK's borrowing rate is significantly higher than most European countries, making it one of the most expensive places for government debt issuance. The reason? Financial markets see risk, and when investors perceive risk, they demand higher returns. This puts further strain on government finances, creating a cycle that is difficult to break. Historically, when borrowing costs soared, governments had limited options: either implement strict spending cuts, raise taxes, or in extreme cases, print more money, which leads to inflationary pressure. None of these options are politically or economically easy, but one thing is certain: the UK cannot afford to ignore this crisis any longer. If action isn't taken soon, the nation could be facing one of the most severe financial crunches in recent history. Why 4.83% is more dangerous than it seems. At first, this might not seem alarming. After all, in the 1980s and 1990s, government borrowing rates were even higher, sometimes reaching 6 to 7%. But there's a key difference. Back then, economic growth was much stronger, and the global financial environment was more stable. Governments borrowed heavily, but they could afford it because GDP, the total value of goods and services a country produces, expanded rapidly, ensuring that debt remained manageable. Today, that equation is breaking down. Unlike the booming years of the past, the UK now faces stagnating growth and weak productivity. Economic expansion isn't fast enough to keep debt under control, and rising interest costs are making borrowing increasingly unsustainable. The UK lacks several economic advantages that have helped other nations navigate debt crises more smoothly. The US, for example, benefits from having the world's reserve currency, meaning it can borrow at lower rates. Germany, with its strong trade surplus, is less reliant on debt to finance government spending. Australia enjoys higher economic growth, making it easier to service its obligations. In contrast, the UK is trapped in a vicious cycle of high debt, sluggish growth, and soaring interest rates. This combination has shaken investor confidence, making UK government bonds less attractive in the global market. One of the biggest dangers of rising borrowing costs is how they interact with existing debt levels. The UK has accumulated significant debt over the years, much of which is now maturing and needs to be refinanced at these much higher rates. This means that even if new borrowing slows down, the government will still face higher costs, simply because it has to roll over old debt at today's elevated rates. This creates an environment where interest payments alone consume an ever-growing share of the national budget, leaving fewer resources for essential services, infrastructure investment, and economic development. The longer this continues, the greater the pressure on the government to find drastic solutions. If interest rates continue their upward trajectory, the UK may soon face difficult choices: reducing spending on critical programs, increasing taxes, or allowing inflation to erode the real value of its obligations. None of these options are without consequences. Spending cuts could trigger a recession, higher taxes could discourage investment, and excessive inflation would diminish purchasing power, hurting consumers. The question now is not just about managing debt. It's about preventing a full-scale financial crisis that could ripple through every sector of the economy. And with global markets closely watching, any misstep could lead to an even sharper loss of confidence, further escalating the problem. What happens if this continues? If the UK government doesn't address this situation, several disastrous scenarios could unfold. The most immediate consequence would be deeper government spending cuts, leading to the return of full-scale austerity. This would mean reduced funding for critical public services, infrastructure projects, and social programs, all of which are already under pressure. Job losses in the public sector would follow as the government scrambles to balance its budget, and entire communities could feel the impact as local services dwindle. Businesses reliant on government contracts would also suffer, triggering a cascade of layoffs and investment freezes. At the same time, if the government chooses to increase taxes instead, the burden will fall on businesses and households, further slowing consumer spending and discouraging investment. A weakened private sector could lead to economic stagnation, worsening the country's long-term financial outlook. Meanwhile, investor confidence in the UK's financial stability would continue to erode. If bondholders fear the government is incapable of managing its debt, they will demand even higher interest rates to compensate for the risk. This could push borrowing costs even further, exacerbating the crisis and making it more expensive for the UK to finance its existing debt. Such a scenario creates a self-reinforcing cycle of financial instability, where the rising cost of debt leads to further budget cuts and economic contraction. We have seen glimpses of this before. The Liz Truss crisis of 2022 was a stark reminder of what happens when investor confidence is lost. During that brief but chaotic period, borrowing costs soared overnight, forcing emergency interventions to stabilize markets. While today's situation may not be as immediate, the underlying risks are just as severe, if not worse. If action is not taken soon, the UK could find itself in an economic quagmire that is far harder to escape from. How the UK can avoid a debt spiral. So, what are the possible solutions? The UK government has a few options, but none of them are easy or politically convenient. The most effective long-term solution is to boost economic growth at a pace that outstrips rising borrowing costs. This means fostering an environment that encourages business investment, increases productivity, and expands exports. However, growth does not happen overnight. Structural economic changes require sustained policies that improve competitiveness and innovation, which have been long overlooked in favor of short-term political gains. Instead of resorting to aggressive austerity measures, the government should focus on efficient spending, investing in infrastructure, technology, and education, which have historically generated long-term economic benefits. By directing resources into areas that enhance economic productivity, the government could help stimulate GDP growth and gradually reduce the debt burden. Another critical factor is restoring financial market confidence. The more stability and predictability the UK government can demonstrate in its fiscal policies, the less likely investors will demand higher interest rates on government bonds. This requires credible long-term economic policies and a clear commitment to fiscal discipline. While some economists argue that allowing moderate inflation could help erode the real value of government debt over time, this is a delicate balance. Too much inflation would create its own set of problems, exacerbating the cost of living crisis and further damaging consumer spending power. A more balanced approach would be a combination of growth-oriented policies, smart spending, and measured fiscal discipline to assure markets that the UK can manage its financial obligations without resorting to extreme measures. The UK stands at a pivotal moment. The choices made in the coming months will determine whether the country stabilizes its finances or falls deeper into a debt trap. Will policymakers make the difficult but necessary reforms to ensure a sustainable economic future? Or will political hesitation and market pressure force hasty decisions that only worsen the problem? The answer will shape the country's financial future for years to come. Whatever the path, one thing is certain. Time is running out, and the UK cannot afford to wait any longer. The clock is ticking. The UK isn't bankrupt, but it is walking a financial tightrope. Rising borrowing costs, slow growth, and weak investor confidence are pushing the government toward difficult choices. If borrowing rates continue to climb past 5%, the risk of a debt spiral will grow significantly. The next few months will be critical. Will the UK stabilize its finances through smart economic policies, or will it be forced into deep spending cuts and tax hikes? The answer will determine the country's financial future. What do you think? Can the UK find a way out of this economic dilemma? Let us know in the comments below, and don't forget to like, share, and subscribe to Economy Explorer and stay updated on the latest financial developments.